Hello, this is the Chartprofit video, almost at the open of the session on Friday 15th of April. This week we've seen the E-mini breakout of its range. We recently saw the 2-month point of control move up to 2041 to this level here. Actually happened about here. Subsequent to that, we've seen value areas pretty much printed entirely in this range here above that level, and an open on Tuesday below that level was quickly rejected. We saw reactive buying, the green at the bottom here, and then aggressive buying at the top, and then we've pushed up here into the high 2070s. Seen no evidence of significant selling for quite a while now. And when this point of control migrated up to this level here at 2041, that became the level to monitor. So a value area now printed below that level would indicate further weakness, but currently we're printing well above that level and no sign of significant selling. Some of the numbers we're seeing here on the breadth: 87% stocks greater than their 50-day moving average in New York, above their moving average, but 87%, quite a high number. 89 the previous day. Nasdaq above 80 previous day, and the Russell 82% previous day. Longer term, I'm assuming this market looks pretty healthy. Certainly the E-mini that we're showing here, the S&P, as long as it remains above 2041. We talked about the divergences recently with the breadth indicators here. As price pushed higher, sets up a negative divergence in the short term, but currently the market seems to be shrugging that off. We have, as you can see here, this is actually the S&P has pushed out to a new high for this move. But as long as these bottom two indicators remain above these lines, the positive green line for breadth on the pulse chart remains intact. The momentum still above zero, so it's green. So this is a pretty positive looking pulse chart. Again, we saw the divergence with price momentum here, although we saw a bit of a range here with this loss of momentum. Again, no real weakness. Going to start looking here at the currency charts. It's actually the dollar index. The major level here is the 2-year at 97.40. Printing well below that at the moment. There's been a bit of a rally this week, but this is still weak price location. Flip side of that is the Euro FX chart, which is just showing a little short-term weakness this week, but as long as it holds above the 3-year at 111.98 here, it's in a strong price location. Price below this level and below this halfway point, just below 111, would put the chart in a weak price location, but I'm making no assumptions about that. We're currently strong above this level, and technical oscillators have got down to here to -50 on the stochastic derivative. Certainly wouldn't be short the euro above that level. British pound has been oscillating around this level. We've been watching for quite a while, the 8-month at 142.60, and continues to do so. We're currently below that level in a weak price location. Until the pound can make a higher low above that level, remains a relatively weak chart in my view. Next we'll look at the sentiment indicators. Seems I'm repeating each week what we've already said. I mean, the RIDEX ratio that we follow each day hit a 3-month high this week, just here. But again, as I said before, considering the rally off the February low, this is pretty tepid reaction up from the lowest level since July 2015 here. Sorry, that was incorrect. That is a multi-year low that we saw in February for the ratio. And if we look at the bull funds in isolation, again you can see their assets that I follow remain pretty low and slow to climb higher here. Bear fund assets have fallen since the February low, as you can see here, but this is, in my view, not particularly aggressive reduction in bear funds. If we saw them break below this level, the previous low a few months ago, that may indicate something, but currently, especially this week with the bear fund assets actually rising a little, I don't think there's too much to concern us here. In the public poll from AAII, we looked at the 4-week moving average of the net, the bulls minus bears, which is here. That average has been rallying with the market. We're into positive territory here, more bulls than bears. But a push above that previous peak would indicate that possibly the market was getting a little overheated, but currently right now, again, I don't see anything in this sentiment indicator from a contrarian point of view to worry us too much. Same thing in the investors' intelligence poll, this level here, yet to be breached. Bulls percentage was actually lower this week at 41.2%. Bears unchanged at 27.8%. The exposure index, which measures current equity exposure of active money managers, never particularly effective at calling tops in the market. We saw it at a level the previous week, last week, which was the highest since May last year. It's actually a bit lower this week, 63.97. And Lipper US fund flows reported equity fund, including ETF, outflows of 4.8 billion in the week to the 13th of April. That's the largest single week's outflow in 8 weeks. And again, from a contrarian point of view, none of these indicators are suggesting that investors are piling back into this rally. Quick look at the stock index ETFs relative to their important levels. You can see the breakout on the spider. The resistance is here, the major at 209.90. That may be a problem. Price above that level would put it in a very strong price location, and we'd be looking for a break to a new high if it did that. And if we look at the diamonds chart, the major is a bit lower here, but the 2-year we've been talking about as resistance at 177.25 had a bit of a problem here, but currently we are printing above that level. So this will be a good chart to monitor going forward as a key chart, and this 2-year point of control at 177.25. Actually, you can see something very similar in terms of resistance. Recent half-range resistance of the Russell 2000 ETF IWM, as we noted here, we are now printing above that level, and again, like the spider, there is the major a little higher at 115.35. Another key chart for the market. Let's look at the bond charts. This is the 7 to 10 IEF, and we have this 4-month level here that we've been following. Chart currently printing almost exactly at that level. If we were to see a lower high like that, that would be a weak pattern. Let's see what develops here. And on the T-bond ETF, TLT, still a strong looking chart. Here's the halfway, more major halfway point. We found a low above that, minor point of control, halfway point off the high. We're currently just printing above there, so no weakness yet in this chart. Gold is a little lower this week. This is GLD, the gold ETF, the major at 118.05. Here we're currently printing below that level in a weak price location due to this weakness this week. The previous point of control, which was support here at 115.50, held. So I'm calling this short-term weakness. If GLD can print some time back above this level, it would be in a strong position, and I think price below 115.50 down here would suggest that we're going lower again. Right now, difficult to call this chart. Finally, we'll look at oil. This is USO, United States Oil Fund ETF. We were watching this big support area here as the chart declined down to its half range off the low and the 6-month point of control, and it held it really nicely. We've bounced off there. Big meeting on the weekend, important for oil. In the longer term, it's actually quite a way down now in percentage terms, but as long as that 6-month at 9, just above 9, holds here, chart will be in a longer term, stronger price location, and it would look like long-term basing pattern. Price back below that level would quickly change that view. Okay, an earlier and shorter video this week. Hope that's okay with you. Anyway, I wish you a good weekend, and thank you for watching.